So good morning and welcome to another of MHP's lockdown sessions. I'm delighted this morning to be joined by Stephen Fine, Chief Executive of Peel Hunt, the City Broker. So in terms of your marketplace, I mean, the City Brokers have been having a pretty good time of it in terms of heightened volumes, levels of volatility, and obviously now quite a lot of fundraising is taking place.
So the environment has been quite interesting. If you took the first half of March, I think you would have had a very, very different story. I think there were a few consecutive days in the middle of March where I was sort of scratching my head, not much to scratch, but scratching my head and thinking, my goodness, what on earth is going on here? But the turnaround, I think, in sentiment, I suppose one of the saving graces was the market reacted very, very quickly. It was a very sharp, aggressive sell-off. And that basically meant that market participants didn't have enough time to react. They couldn't sell if they wanted to. It was effectively taken out of their hands as the market just fell. And since then, it's been a question of, okay, now what? Because the market discounts, the market looks into its crystal ball and tells you what it wants, or what it sees happening. And then when it's reacted, it then says, okay, what's now going to happen? Who are the winners and who are the losers going to be? It starts to polarize perceptions and beliefs into COVID winners, if there is such a thing, and COVID losers, which obviously is very tragic.
And do you think the city's had a good crisis in the sense that markets have remained open and there haven't been the circuit breakers, the short selling has still been allowed?
I mean, very clearly, keeping markets open has been a primary aim of our major recognised exchange, London Stock Exchange. In conversations I was having with them as we went into early March, it was a very important function for them to maintain the ability for retail, in particular, to access their savings if they needed to get hold of money, savings, sell shares, etc., whatever they wanted to do. So keeping markets open was absolutely vital. Keeping markets open and maintaining stability, providing liquidity, was obviously very important. And I think the markets have demonstrated their ability to actually operate and function effectively and efficiently at times of extreme stress. I think the circumstances that we're living in and working in right now are unprecedented, and they are extreme. And market positions of heightened risk and intensity are difficult. For us, the important thing is to understand and recognise that, but also to understand and recognise that even among our own staff, there are individuals whose wives or husbands or parents or children have either been furloughed, lost their jobs, been ill, and sometimes in tragic circumstances even lost their lives. So for us, it's important to put everything into perspective here. So we're doing our best to ensure that we do the right thing. It's very important in this environment to make sure that we abide by government standards and regulations. We keep that working from home ethos, but we are maintaining market integrity, market liquidity, and supporting equity markets where we can, but also helping companies raise money, which will help them preserve jobs and preserve their own standing and the jobs and the livelihoods of the people that work for them, to hopefully get through this difficult period.
In terms of MiFID II, which has obviously been a major issue for your market, and obviously has impacted your corporate clients, our corporate clients, quite significantly. Do you think this crisis has changed anything in respect to that? Do you think it will change the regulators' attitude going forward?
You'll probably find the regulators have got other issues on their mind to look at first. And I think regardless of what they do with MiFID II, the die is cast. The buy-side institutions and sell-side investment banks like ourselves have spent a lot of time and money and effort adapting to that new regime. Any tinkering or slight changes to it, I will be surprised if they're adopted by particularly the buy side. If you want to look at regulatory change, I mean, you can see already, for example, deferring taxes, and also delaying publication of accounts has been a key help for a lot of companies in this COVID environment. But on the wish list probably will be some changes to maybe the prospectus directive, or maybe even allowing retail better access to primary, or maybe should we say secondary transactions.
Yeah, what's your attitude, for example, to the new primary bid platform to encourage retail investors? I've been reading a bit about that recently, particularly on social media. Is that something that Peel Hunt have sort of signed up for in effect?
We've had a very effective intermediaries offering platform called Rex that we've been running now for about 2 or 3 years. And we found that that allows us to aggregate retail demand very effectively, very efficiently in primary market transactions. And we've seen it bring somewhere between 10 and 20% of incremental demand to every transaction that we've actually issued it from. It doesn't go direct to retail. One of the issues that you have, it goes through the intermediaries, so execution-only brokers, wealth managers. One of the issues you have is in secondary transactions, you are quite hampered by the prospectus directive, so it's a bit of a tongue twister, where any issue more than 20% requires a prospectus. And again, you have that incongruity where a retail investor can buy a share at 8:01 in the morning without a prospectus, but is prohibited from buying shares in an offering that closes at 8 o'clock that needs a prospectus. So you have that incongruity there. So I do believe that's something that will be tackled.
And in terms of the market, I mean, obviously we've seen quite a strong rally in the last couple of weeks. Do you think at these levels it's sort of upward events? Do you think it's, I mean, without giving investment advice, is it a kind of buy, sell, or a hold in Peel Hunt's view?
As you quite rightly point out, I'm not on this webinar to give investment advice. A lot of people have been using the analogy of certain letters. Is it a V? Is it a U? Is it an L? Could it be a W? We've taken the view that it's a bit more like a Nike swoosh. Not that I'm plugging Nike shares here at all, but we think that type of tick shape is probably more like what you're likely to see.
What have you seen, Stephen, in terms of sort of increased levels of activity as a result of the lockdown and as a result of the crisis?
I think if you're a liquidity provider in whichever products, bonds, ETFs, equities, currencies, commodities, you would have found the volatility and spreads that have probably widened in volatility because of this volatility probably better for you as a business. For us, our market share in retail trades has now topped 50% in certain weeks, and we're averaging around 45%. But in March and April, we processed 36 million quote requests. That's people sitting at home tapping in BOD or BP or whatever shares they may be looking at. We executed 2.5 million trades in March and April for a total notion of some 11.5 billion sterling in value. And on one particular day, we did 183,000 trades. So significant volumes and significant activity taking place. And I've also heard anecdotally companies like Flow Traders, Jane Street, other market liquidity providers have had a tremendous time in the last couple of months because of the liquidity provision services that they give.
That's really interesting to hear, and I suspect that although there's a short-term spike, they'll the benefits of that activity will probably continue. Because it's clear that lots of us are still going to be working from home for some time. Do you think that we'll see a slow but steady return to M&A, and perhaps given the funds being raised by certain companies for war chests, that actually we might see quite a good M&A market sort of going through into 2021?
I think you're right. The M&A market is normally a lagging indicator. We see the severe stock market reaction, we see the preventative, the urgent and the opportunistic fundraisers by companies that are looking to tap the equity market and reschedule debt. But we've also seen is a bit of a polarization in private equity funds. Some that have found portfolio companies taking up the majority of their time, others that have been successful and are looking to raise additional funds. I even saw HG today, I think I've got about 11 billion or something they've just closed. Conservative estimates say there's something between $2 and $3 trillion of firepower available in the private equity world. Which is a staggering sum of money. And with any stock market dislocation, there'll be those that on a more predatory basis will be looking carefully at key targets. So I think while things are settling down and while companies are dealing with their own balance sheets and trying to reschedule some of their debt, private equity funds will be circling, speaking to them, offering to help. They've got the firepower, they've got the capability. And as we move into the summer, I would not be remotely surprised to see quite a big increase in the amount of M&A taking place.
And by the same token, that leads me on to the thought, will we see more consolidation in the city amongst the brokers?
Brokers are always difficult things to consolidate. You typically find consolidation in brokers tends to happen from positions of weakness, where you get sort of 1 + 1 equals as close to 2 as you possibly can, as opposed to 1 + 1 equaling 3 or more. We've seen quite a polarization of broking or investment banking houses, particularly as a consequence of deequitization last year, the rise of passive investments, and also regulatory change. And I think COVID has absolutely exacerbated a lot of those issues for a number of peers in this industry. So those that are reliant on transactions, if they aren't distributing research, are going to find their corporate client list more challenged and perhaps a little bit more smaller to microcap. Those that have strong focus on distribution and very strong links to shareholders will probably find life a little bit easier and able to win a greater number of higher quality corporate clients. Those also that have trading platforms or liquidity providing platforms, I think will also have found life probably better in the last 8 weeks. Given the market dislocation that we've seen.
One of the great themes that we've all been wrestling with, on the advisory side of things for both yourselves and ourselves has been the issue of de-equitization, by which we obviously mean the shrinking of the stock market in terms of the number of companies that are listed. Do you think this crisis is going to make that worse, or do you think it might just, with a bit of luck, lead to a kind of inflection point and an improvement in fortune?
I do think there's a growing polarization in thought process. Go back to the end of 2019, de-equitization was in full swing. The general election result brought a sense of confidence and the sense that the actual de-rating of the UK might start to close versus European and maybe even US peers. And one of the issues around that was the extreme apathy or dislike of debt in the UK marketplace. 1.5 to 2 times EBITDA was seen as redlining, whereas in the US it's perhaps 4.5 times. Use your capital structure, borrow money, it's cheap. So that meant that a lot of cheap companies were being taken out by those that were using debt to finance that purchase. The Boris bounce, as I said, may have looked at the closing of the valuation gap, and we were starting to think that there could be, as you approach January and early February, a number more IPOs to redress some of that balance. Now, COVID has had actually quite a significant impact. So first of all, the world has now decided that debt is not necessarily the best thing to have. And despite the level of cheap money out there, it's been very, very clear that debt is temporary and equity is permanent. So therefore, do you want to keep restructuring debt and piling on debt and adding more on temporary measures in that are effectively kicking the can somewhat down the road? Or do you want to restructure your debt and then think carefully about that equity debt balance? So actually what we believe is likely is that whilst there will still be some de-equitization taking place because there are cheap companies in the marketplace, the potential for IPOs or re-equitization rather than de-equitization might be a new phenomenon as we go through 2020. So I'm somewhat optimistic about that as that paradigm shift from debt towards equity starts to manifest.
Thanks very much, Stephen, and thank you for concluding on that positive note about the potential for the future.